Paul, thanks so much for joining us. So pretty much in line with expectations, obviously a positive number when you're talking about the consumer on the street. The question is, I suppose actually let's first start off by unpacking the numbers, because if you take a look at the key weighting there, 36% to food and non-alcoholic beverages, you've got that sitting at 2.91% year-on-year inflation. So pretty much it's the decrease in food inflation that's helping this inflation number overall.
Absolutely. I think food is critical, being a very, very big part of the basket. But I think when you take a closer look at the inflation figures, one of the things you note is that what we are really getting is price stability. If you look at the last 3 months, the index hasn't really moved much one way or the other. So it's really that prices are stabilizing, and the base effect from the high inflation that we saw towards the end of last year is then kicking in and resulting in lower inflation. And that's what we are seeing happening. So a lot of this being more as a result of the base effect. In effect, when you look at the month-on-month movement, this is the first month first month since April where we are seeing an actual rise on a month-on-month basis. So yeah, it's perhaps indicating that it's more out of price stability rather than significant movement in specific commodity prices.
Where do you expect the inflation number ultimately to bottom out? Because, I mean, 5.32% is extremely low right now. That's, of course, compared to where inflation was last year. But ultimately, when is this number going to bottom?
I think when you look, if you project forward, I think the expectation in terms of rainfall for the next months, the weather forecast is focusing very high rains in the short rain season, which begins in October, which means that food prices should remain stable or decline. And when you look at the base effect again kicking in, I'll not be surprised to see the next inflation figures coming out at about 3.7, 3.8%, and probably dropping on to about 3% in November. I think we've still got some way to go in terms of the drop in inflation, but I think the turnaround should be around December, January, where we should then begin to see stability.
But to what extent, as we go into 2013, is this inflation number then at risk as a result of the drought that we've seen in the US and also other parts of the world that are key food producers? Because Kenya does produce food locally, of course, but that, of course, that international food price inflation will start to have an effect surely on Kenya as well.
Well, yes, to some extent, but I think when you look at Kenya still's got some significant tariff barriers in order to be able to protect local farmers. So perhaps we are not yet playing in the game of the international food prices in terms of the key consumer commodities, maize in particular, and the short-term crops which are consumed. So I don't expect the international food prices to have a very significant impact on inflation. I think we might expect to see continued stability on the inflation front.
As you say, local industry protected to a degree. We've also seen Q2 inflation, GDP numbers coming out, 3.3% growth. The IMF also coming out and saying that they're continuing to forecast growth in excess of 5% for this year in 2013. So that, of course, a little bit more bullish than the number that we've seen for Q2. What is your evaluation of the slowdown in momentum that we saw in Q2?
I think it's not unexpected. We've got to remember that we've had a very turbulent macroeconomic environment, and we've got to remember that these figures are 3 months behind us. They are for Q2. So when you think about the time when we had the high inflation and the high interest rates, that perhaps hit the peak in around that time, or the impact of it, given that there is a bit of a lag, must have been around that time. So I think the decline in GDP is a manifestation of the very erratic macroeconomic environment that we went through towards the end of last year and the beginning part of this year.
So would you be also on the side of the IMF saying that growth is going to be as high as 5% and perhaps higher this year?
I don't think we will get to the 5%. I think we might be slightly below, but I think going forward for the third and fourth quarter, I expect a significant improvement in GDP numbers.
And then, of course, let's talk about the outlook for interest rates, because the CBR rate sitting at 13.5%, of course, well above where inflation is now. How many more cuts are we going to see, and what size of cuts are going to come forward in the next few meetings?
I think when you look at the outlook on inflation, I think there is room for the central bank to cut rates further. So I expect to see further cuts coming through. Again, now they're meeting on every 2 months, so I think we've got some time before we get there. But the outlook on inflation supports further cuts. So I would not be surprised to see a second big cut on the CBR rate. However, what is a little confusing is that when I see what the government is doing on the repo rate, it seems to be the opposite of what they are doing on the CBR rate. When I look at the figures for the repo market for the week ended 21st of September, they actually took off 3.1 billion, sterilized 3.1 billion in liquidity. That, to me, is a constructive monetary policy and not an expansionary monetary policy, which effectively sending mixed signals to the market. Yeah. And indeed, we are seeing a manifestation of that is that we are seeing the Treasury bill now begin to turn back up from a drop to about 8%. It's now shot up again to about 9%. So mixed signals being sent out on the interest rate front.
But surely the central bank governor and the central bank would know this. I mean, you know, as you say, they're sending mixed signals to the market. Perhaps this is then just a short-term issue when it comes to taking that liquidity out of the market.
Okay, seems to be a mixture between effectively trying to shoot two targets with one bullet. Because I think at the same time they are looking at the exchange rate, so they are likely to maintain exchange rate stability, but at the same time looking to encourage interest rates on a downward trend. So I think that's where the confusion is coming from.
Paul, thank you so much for joining us today. Great to have you on the show. Paul Mwai, CEO of AIB Capital.